Evening. What do you want to do tonight?
The same thing we do every night, Pinky.
Velocity
Climb.
banking.
Yes, we're going to do velocity banking again today. So that's what we're going to do. And today's video, we're going to talk about how we could possibly make the banks freak out and collapse. And by the way, if you don't know who I am, I will show you. I am some random dude on the internet who paid off a mortgage in 2 years and 9 months. Wait, where's the Vine Boom sound effect? Let me say that one more time again. I paid off a mortgage in 2 years and 9 months. There we go. All right. So let's get started doing velocity banking. And so, first thing I wanted to show you is let's quickly answer the following question. Why would the banks freak out and collapse if we all paid off our mortgages under 3 years? It's a question I've been asking over and over again. Because I feel like whatever I've done isn't quote normal in society, and the bank doesn't expect us to do what one person, me, did, right? But if everybody did what I did, then probably they would freak out. So let's go ahead and see why they would freak out.
Banks would freak out because mortgages are a major source of predictable income for them over decades. Here's the breakdown. 1. Interest revenue loss. Mortgages are loans that banks charge interest on. Most of that interest is profit for the bank over the life of the loan. If everyone paid off mortgages in 3 years, banks would get far less interest than expected, drastically reducing revenue. 2. Liquidity and reinvestment issues. Banks often use mortgage payments to fund other loans or investments. Rapid payoff would give banks a sudden influx of cash they weren't planning for, which could disrupt their lending and investment operations. 3. Financial system risk. Banks bundle mortgages into mortgage-backed securities, MBS, and sell them to investors. Early payoffs could destabilize these investments, potentially triggering wider financial repercussions. 4. Profit model disruption. Banks rely on long-term interest payments as a stable profit source. A mass early payoff would collapse that model, which is why it could lead to panic or even bank failures if they can't adjust quickly. In short, it's not that the banks would go bankrupt immediately, but their expected profits and financial structures would be severely disrupted, a shock to the system. If you want, I can also run a simple calculation showing how much interest the banks would lose if everyone paid off a typical 30-year mortgage in 3 years. It's eye-opening.
So
Do you want me to do that?
TLDR, so TLDR, how do we make the banks freak out and pretty much potentially collapse? Not saying we're going to do that today. Well, it's basically pay off your debt quickly, and that's one way we're going to do it using something called velocity banking. So let's go ahead and get started. So velocity banking, what is it? It's a debt payoff strategy where you throw all of your money into debt with the help of something called line of credit. So first step is creating a budget. So you have your income here, expenses, and then your leftover checking and savings. And then in the expense breakdown, we list every single debt that we have. So we have 3 credit cards here, an auto loan, student loan, and a mortgage. And then on top of that, we have our personal expenses, $2,000 a month, right? And then here with velocity banking, what we're trying to show is with the same income and the same expenses and debts, we can easily pay off the debt without really any sort of sacrifice or adjustment to our lifestyle, right? And what we're also going to assume is we have something called a line of credit. So what's a line of credit? It's basically a financial tool where you can borrow money, pay it back, and then use it over and over again. So this is my $373,500 home equity line of credit. And then as you can see here, I have a $15,000 personal line of credit. And if I go to the bank's website and I just click the button, hey, I want $15,000, and I click transfer funds, then I just have $15,000 going into the bank account at a 15% interest rate. So what we're going to do is assume we have access to a $30,000 line of credit at 15% interest rate, personal line of credit. We're not going to deal with home equity, even though we are a homeowner, right? We are a homeowner, but we're not going to deal with home equity line of credit for now. And so what we're going to do, okay, what we're going to do is we're going to use this as our main operating account. And we're going to move some debt here and then just dump all of our money in and take our expenses out. So if you've never heard of the cash flow index model, but basically all it is just a formula of debt divided by the payment, and then it gives you a ranking system. And so the lower the number, the more debt the more bang you get for your buck in terms of cash flow for paying off the debt. And then the higher the number, right? That's the one you want to pay off last. So the reason why I want to pay this one off last is because we literally have to give someone $200,000 in order to get $843 of cash flow back in our life, right? So let's get rid of these debts first in a certain order, right? This order here, and then go one not one by one, but let's say we start off with the credit cards first, the 20s and 30s, and then we're going to move it into a line of credit. Now, because I'm lazy, right? I magically took a line of credit that's a little bit higher than all the credit cards, but in real life, it's probably not this way. And by the way, if you don't know who I am, right, I just want to show you something that I have over $739,000 in credit cards and lines of credit. Top 0.01%, $739,000. And every time I have to say that, oh, dang, somebody's calling me. One moment. Anyways, I'm back. All right. So, what was I saying again? Oh, yeah, I have over $739,000 in credit card limits and lines of credit. And every time I say that, I think something happens. Let me say it one more time because I feel like the producer guy is asleep at the wheel. I have over $739,000 in credit cards and lines of credit. There we go. All right. So, yeah, the reason I tell people this is because a lot of times people don't want to hear the secret of getting credit, which is banks don't lend money to people who need it, right? And so it's very important to understand that. So I know a lot of people out there is like, "Whoa, I wish I had a line of credit." And it's kind of like getting car insurance, right? You got to get the car insurance before you start to drive the car, not after you crash it and then there's no insurance, okay? That's a very bad deal. But it's tempting, but it's a very bad deal. Okay? So now what we're going to do is move some of the debt into the line of credit and then increase our cash flow. So we added this up, so this is like 28,000. Okay, 28,000. And then what we're going to do, okay, what we're going to do is once we move this credit card debt into the line of credit, oh my goodness, take a look here. This goes from 886 to 1808 of cash flow without making more money. Now, what's the difference between average American banking and the velocity banking style? It's not the income, it's about your checking account. Is it supposed to be the final destination of your money, or is it supposed to be the middleman? So if you take a look here, money comes in and it just goes right out, right? So then if money comes in and it just goes right out, then that's essentially means that it is the checking account is essentially the middleman, and that's what we plan to do. We plan to make the checking and savings zero as much as possible, and that's what we're do. And then the final step is you put your entire paycheck into the line, take your expenses out, and then rinse and repeat over and over again. So let me just go ahead and do this. H2 minus 1808.66, right? And then we're going to take the average daily balance, right? Average daily balance multiplied by the interest rate and then divide by 12. Actually, interest rate is 15. So let me correct that, not 12 or not 8. And then you see that we pay how much interest we pay on these lines. All right, so now we see that in 18 months, we paid off that line of credit. So, people freak out about credit card debt, but the credit card debt is gone. And then let me just do this. So 18 months, 28K, 28K. All right. So 28K. And then here we have an auto loan, student loan, and the mortgage, right? So auto loan, student loan, and the mortgage. And we have a loan calculator. So I'm just going to do this right here where I type in 18 months for all of the debts. And then you could see the current balances here. Just going to use the same cash flow index model here. And then I'm going to move the auto loan into the line of credit. Let's go ahead and do that. And then I'm just going to do this plus 15742.48. And then this is going to be 0. And then this is going to be now 2,000, right? And then this is going to be minus 2203.97. Okay. Whoopsie. See how long it takes for us to pay it off? So it's 25 months. Now the car is paid off in 25 months. And then it's going to be 22,000 plus 28, so that's 50K paid off. And then now it's a student loan, so 25 months, what's the balance of the student loan? This is 0, 25, 25. So 32 grand. Let's move. Should we move that into the line of credit? Probably not. Now I'll tell you why. If you have a huge difference between the interest rate, right? Like this is 7, the line of credit's 15, and this number is kind of big, it's probably not worth it to move it into the line of credit, but we can do something called chunking, and it would pretty much be the same thing, or it would have the same effect as, let's say, or it would probably be much better, not probably, it is much better than moving the whole loan into the line of credit if there's a huge interest rate difference and you also have a relatively high number here. But I'll demonstrate with the mortgage, much easier to demonstrate. But let me just kind of go here. So let me just add this to what we're going to do, something called chunking, which is moving a piece of the loan into the line of credit. And then what is the monthly income? Monthly income is 5,500, 5,500, right? Where'd my calculator go? Okay, so 5,500, and then the expenses, let's just take a look here, is $2,000. So 2,000, no, it's 2,2843.21. You're supposed to take everything except for the loan you're paying off. 2843.21. And then what we're going to do is just put in the deets of the loan. So 10 years is usually how much a student loan is. So it's 452.82. So 452.82. And then what's the original balance? The original balance is 200,000, 200,000. And then the current balance, oh, actually, my bad. It should be 39,000, so 39,000. And then the current balance is 32,954.39. So 32,954.39. And then what we have is the chunk amount here. So the chunk amount is just how much we're going to move into the line of credit. So we'll just take a small amount. So we'll take about $6,000 and do 15%. And then you see it gets paid off in 1.1 years, right? Now let's do 30. Let's go crazy. Yeah, that doubles, right? So, no, actually it doesn't double. It's $500 more, right? So let me see what happens when we do 8%. $300 less. But the time frame is relatively same with the payoff. 15%, 1.1 years. So we're going to do that right here. So 0. So it'll be 25 divided by 12 plus 1.1. So that's 3.18 years. Actually, let me do this. We got to do it in months. So it's 25 plus 1.1 times 12. So that's about 39 months, right? 39. So let's just do that right here. So we're in month 39. There's going to be 0. And then, yeah. So now, okay. So same thing, right? Then we got to pay off the mortgage last. And why do we have to pay off the mortgage even though at first glance it looks like we shouldn't pay it off at all? I mean, it's a 3% interest rate, and if we have a very relatively low payment compared to the amount that we borrow. Well, if you don't pay it off, right, and you get to the 30-year term, you've essentially paid 50% interest on the entire thing. So, for example, if I go to 360, you'll notice this goes to $100,000 of interest paid from a $200,000 balance. Okay, so let's take a look here. This is the original balance. So the original balance is 200,000, so 20,000. And then the current balance is 185,959.04. So 185,959.04. And then bam, gets paid off in 4.8 years. So, if everybody paid it off in under less than 3, I think every bank would freak out, right? Because you've ruined their major source of predictable income. And if you don't know how an loan amortization schedule works, right? Loan amortization schedule. And we go to a calculator right here. If you do a 30-year mortgage at 6%, right, you end up paying more than 100%. You end up paying more on the house than you did on the yeah, you end up paying more on that. I'm sorry, more on interest than you did on the house, right? And if you do 3%, right, 3%, then that's about 50% interest, which is still a lot. So 6% interest, right? 3% interest. Okay. All right. So now let's go ahead and do this. And all right. So now let me just kind of do this here, and we'll take a look. All right. So now, how long did it take us for us to pay off that mortgage? 4.8 years. 4.8 years. Now let's see if we used a 30%. Actually, move the whole thing into a line of credit. That's 15%. Although our line of credit limit is only 30,000, let's just assume we got a huge line of credit. It would take us 7.5 years, and we pay 40 grand more interest than we have to. Yikes. Right? That's not that efficient. So let's go ahead and do that, and then it'll be 0, 25 months, 25 months, and then, I don't know, student loan. So, okay. Oh man, I forgot how many, 1.1 years, right? So 25 divided by 12 plus 1.1 plus 4 point, what was it? 8. 4.8. No, that's not right. Oh, it is right. Okay, 4.8 years. Oh no, 4.8. Okay, there we go. 7.98 years debt free. Debt free. All right. So just imagine what would happen if we all did this and we paid off our debts quickly. You've kind of ruined the bank's source of predictable income, and possible. I'm not saying it's going to happen, but a possible collapse, possibly. But do you like the thumbnail I created in ChatGPT? Bank collapse, very dramatic. It's like an earthquake, one of those Tokyo earthquakes. You know what I mean? I should probably put Godzilla. Like there's like a Godzilla figure, and then there's a bank, right? And then the Godzilla would have like some sort of branding of velocity banking. Now that I think about it, let's go ahead and create that image. Can you create an image of Godzilla attacking a bank in anime form? Godzilla using velocity banking. Let's see what this is. I'm going to pause 1 second. There we go. There we go. I don't understand what makes this velocity banking, but maybe that's how the bank feels when you pay off your debt super quickly, right? Okay. All right, well, that's it for today, folks. This is Korean Atlanta Mentorship, your debt guide, your debt quote mentor. I don't give financial advice, disclaimer, and I am not your attorney or accountant. All right, well, have a great day, everybody, and I will see you all on the next video.